All right. Today is Thursday, June 22nd. This is a recap of the stock market activities today. And folks, I got a good one for you tonight. Before we start, thank you so much for the kind words last night. I'm feeling a little better today, although in the morning it was a rough morning because I was bleeding from my nose. You know, when the sinus pressure starts to kick in, and I was bleeding all over the place. It kind of reminded me of my boxing days, and I had to stuff my nose for a little while so the bleeding can stop. But anyways, feeling better now, and we'll see what happens over the weekend. But let's read some of your comments here. I'd be very happy if you could add Ethereum to the charts analysis. We'll do that today. Here's another one. Just became a member today. Keep up the good work, Mav. Thank you so much. You know what's really amazing? The more this channel gets attacked and criticized, the more support we get, which is absolutely insane. I thought people would bail out. But in reality, we keep getting more and more members and more upgrades, and it's really overwhelming. So thank you so much. And then here's another one. Hey Maverick, why of all tickers is Tesla almost always the heaviest option ticker in the market? Thank you for all you do. I think it's a retail phenomenon because if you recall, before 2020, the heaviest traded options were for Apple. Apple almost always was on top. And the reason is it's the most owned, so you have to buy puts on it, you have to buy calls, so you can add more shares and that kind of stuff. When it comes to Tesla, if you look at the chart of Tesla, you're going to see a lot of booms and busts. That's how the stock moves, booms and busts. It goes way higher, then it crashes down. Then it goes way higher again, it crashes down. And this is all due to options. A lot of folks trade the stock based on options, not because they buy the stock. And maybe it's because it is a popular name. Everybody knows Tesla, everybody knows Elon Musk, but the stock is not cheap. It's too expensive. I'm not talking about valuations either. I'm talking about the price. It was trading at, before the splits, of course, it was trading almost at $1,000 a piece. And now it's trading at $250 a piece. So it's not a cheap stock. If you want to buy, let's say, 1,000 shares or 10,000 shares, for a regular mom and pop investor, that's too much. So they use call options instead. And what happens when people use call options? The market maker has to do the buying for them. They buy the shares, but at some point the gamma squeeze ends and they have to dump these shares rapidly. So we see the chart of Tesla goes higher, really fast, rapidly, then it crashes down. Lather, rinse, repeat. And maybe also because Tesla is the sweet spot of a stock that moves in erratic ways, and you can make a lot of money from these options if they're priced down. If the implied volatility is low and we see options for Tesla cheap, the demand comes right away. We see another gamma squeeze starting, and they don't stop until these options become really, really expensive, as we're seeing right now, and then the gamma squeeze ends. I'll show you what I found out today in Tesla and Amazon, Merck, and the VIX, all of these options and what they can tell us in the options market coverage. It's going to be a lot of stuff, so stay tuned for that one. But let's begin the coverage here by talking about the most important piece of news that we got today, which is the Bank of England now raising rates by 50 basis points. Of course, they say, oh, this was a surprise. Nobody anticipated that the BOE will do 50 basis points, except we talked about it in this program, that the BOE is way behind the game, and they have to catch up really quickly. They have to do 50s and 75s. In doing so, though, they're going to blow up the economy. I say it's not a surprise to me because if you look at the benchmark rate for the BOE, it's way below the CPI inflation rate. So is it really surprising that we got 50 basis points from the BOE? Of course not. And now the market is pricing in 6% interest rates. So there is higher for longer. Not just the Fed, but the BOE and many more. We'll talk about that in a minute, but here it is. Folks, if you remember that back in 21, I was saying the Fed gonna start raising rates immediately. They have to start tightening the monetary policy. And even when they began late in 22, I said get it higher as fast as you can. Shock and awe. Go to 5.5% right away, fast, within a few months, and that'll do the job. But the longer you wait, the higher the terminal rate will have to be. So the 5.5% that was supposed to do the job last year is not enough today, and the Fed will have to go to 6-7%. But again, the longer you wait, the more problems start to appear in the economy. And now they're stuck between a rock and a hard place. They know they have to raise rates significantly higher because they were too shy last year and they were too late in 21. But the problem is we have a lot of systemic risk that prevents rates from going higher. If you're going to raise rates, be prepared for a lot of things to blow up. Silicon Valley Bank was the appetizer. And now you look at yields in England, for example. They're going back to the same levels when we got the crisis from Liz Truss. And if you look at the 2-year yield here in the US, we're going back to the same levels when we got the SVB collapse. So the odds for another systemic event is really, really high right now, but nobody's paying attention. Everybody's indulged with AI. Today, Amazon says AI, the stock is up 4.5%. Meanwhile, you look at the yield curve and look at this. We're going back to the same inversion levels that got us the SVB collapse. And this is really ominous. I mean, if you look at this, people dismiss the yield curve inversion. That doesn't mean anything at all. Except since the 1970s, it predicted recessions accurately. Therefore, I say if you happen to be bullish the stock market, you gotta believe that this time it's gonna be different. And if you're old enough, you've heard this phrase, this time it's gonna be different over and over and over and over again. And it was different until it wasn't. And there is a simple reason for that. Human psychology doesn't change. And now we have perhaps the steepest yield curve inversion since the 1980s. So we know a recession is coming. The question becomes when and how. If you look at leading economic indicators that we got today, it dropped down even more. And we're now looking at a recession signal, not just a warning signal. We got a recession signal. And every time leading economic indicators went down like this, we got a recession. And therefore, I say the bubble that we have right now is the most dangerous bubble I have ever seen in my life. It is happening exactly at the wrong time. It's happening in the most valuable companies in the world. And if this bubble bursts, what do you think will happen to the global economy? These big names will take the global economy down with them. Even JP Morgan now says recession will be likely necessary. JP Morgan just issued a strong warning about stocks, says the impact of spiking rates has yet to be felt. And that's another point. You know, last year when everybody was saying, hey, Jerome Powell has to cut it with the rates, he has to stop or pause because we have the lag impacts. They have to wait and see what the lag impacts are going to do. All of a sudden, they don't talk about the lag impacts anymore, even though rates went significantly higher since then. And of course, the great economist Milton Friedman taught us that monetary policy works in variable lags. And the reason is the feedback takes a little time to work its way throughout the economy. And if you understand the fact that in 10 years plus, we've been accumulating a lot of debt in this economy, in real estate, in small businesses, in technology companies, in startups, and all of that debt has to be refinanced at some point with higher rates. And a lot of these companies, as zombie companies, they're not really profitable. They will be under severe stress if they have to refinance all of this mountain of debt at 5-6%. That is the upcoming storm, which we can see, by the way, but everybody seems to ignore. And of course, we continue to follow the politics within the Fed. We know we have an internal conflict. We have Team Powell and the Hawks, which they're now not becoming Hawks anymore. And then you have more doves showing up. We talked about Bostic last night. Now you have this tool Goolsby from Chicago. He says he doesn't know how he will vote in the next meeting. I'll tell you how he's going to vote. He's going to vote for a cut. That's his job. He was handpicked by the oligarchy and the banks to sway Jerome Powell, because we know that Jay Powell was heavily influenced by Brain Dead. Brain Dead now works for the Biden administration. Who's going to be the dove who's going to add pressure on Jerome Powell to back off and let the banks live? Who cares about inflation? It's this guy right here. The problem is, all of these guys are not in charge. Inflation is. And folks, when we talk about inflation, I told you the most important number to watch for is core services x energy. That's reading at 6.6% year on year right now. And for the Fed to tackle inflation properly, they have to go above this rate, meaning the Fed funds rate has to go above 6.6%. The sooner the better. Otherwise, you're not going to get this inflation down. And it wasn't just the Bank of England. It was Norway, the SMB, all raising rates. Now, we have pauses too. We have Indonesia, we have Philippines, Brazil, all pausing today. But those countries are almost in a recession right now. Then you got Turkey, here it is, raising rates to 15% from 8.5%. So central banks are now raising rates. They realize that this inflation problem is not over. And again, when you consider the mountain of debt that we've accumulated in the global economy since quantitative easing started, all of this will have to be refinanced at these insanely high rates. Tell me again things are not going to blow up. Now let's segue to markets, because we got this piece of data that we've seen the largest outflows, not inflows, outflows for the QQQ in about a year or so. So why isn't it down, Maverick? And who's doing the outflows? One step at a time, here it is. Traders dumped $3.1 billion from the QQQ on Friday, just as the exchange-traded fund snapped a 6-day winning streak. The product, which tracks the NASDAQ 100, has now fallen nearly 2% since the cash exit. Traders have continued to move away from the fund this week, pulling an additional $1.3 billion on Tuesday. Some people are really just convinced that the AI beneficiaries have run too far, too fast, and now they're getting worried, said Lauren Sanfilippo, senior investment strategist at Bank of America Private Bank and Merrill. Now, let me tell you this from my sources, because I talked to the big ones, the big fund managers, all of them, and they have enjoyed the AI rally when they were doing it alone. But boy, do they hate it when the mom and pops join them. When they start to see the mom and pops joining and winning and manias appearing, they pull out right away. The Friday outflow also coincided with a large amount of options-related activity. About $4.2 trillion of futures and option contracts tied to the stocks and indices matured on Friday. The Q's combined call and put options interest totaled over 17 million contracts at the end of last week, the highest level since 2004. Wow, this is the most important part though. After the outperformance of stocks over bonds this quarter, JP Morgan Chase & Company estimates that the global pension funds may need to sell roughly $150 billion worth of equities to keep their required stock-bond allocation targets in check. Now, this is a point that a lot of retail mom-and-pops investors don't understand. A lot of funds, the big ones, they have requirements. You can't be way overweight stocks because that is considered too much risk. So we have window dressings and we have rebalancing all the time. And now that the stock market went way too high, too fast, led by the biggest names in the world, the allocation in these funds are way overweight for stocks, aka equities, versus bonds. So this number that you see right here, $150 billion, is actually conservative. It could be as far as $250 billion. They have to pull that away from the Qs, and I say the Qs because that's where the majority of the rally came from. 7 stocks, that's it. And they have to allocate all of these funds to bonds. Now, the pullback that we got in the NASDAQ, about 2% from the highs, that was due to $3 billion coming out. Can you imagine what will happen if $150 billion comes out of the equities market? We're going to see a significant pullback. And that's going to happen by July. Technology stocks that have outperformed every other equity sector this quarter are ripe for that selling. There you go. The problem is, the outflows right now from the institutionals and the funds are being encountered by who? By the retail mom and pops. The largest inflow into the Qs, into Nvidia, into Tesla by the mom and pops that we have seen in about a year now. $1.5 billion. So you have $3 billion out, but it's being balanced by $1.5 billion from us, the mom and pops, chasing the mania. Not a good dynamic here. Every single time when the big guys pull out and we jump in because of FOMO, it doesn't end well. And again, I keep saying for us, the mom and pops, you got to understand this. You don't have to chase. You're going to lose money, I promise you. I know a lot of our community here who said, Maverick, I'm done. And this is last week. I'm going to go all in and buy Nvidia right now. I'm tired of watching the market go higher and me not participating. And I said, good luck. Best wishes from me. Now they're up 3% on Nvidia and they feel pretty good. But when you see those outflows coming and then they go down 20% in the position because they bought at the top, are they going to feel pretty good? Of course not. But we always fall in the same trap. Folks, if you want to chase the AI mania, if you believe in it, you're going to get better prices. I promise you. These things are going to pull back, and at that time, you can buy them at a cheaper price if you still believe in the narrative. Furthermore, you don't need to feel FOMO. I've never understood that. Never. Because if this is indeed a bull market, think about the opportunities that we have in a rotation. If it is indeed a bull market like 2020, then we're going to see a rotation. And that means you're going to see sectors such as banks, cyclicals, metals, energy, defensives, utilities, real estate, Chinese stocks. All of these are opportunities. And they're going to go higher, 15, 20, 30%. That's an opportunity. And if this is not a bull market and this is just another bubble, then it's going to go down crashing. And your opportunity is in shorting these names. There is no such thing as FOMO. Doesn't make sense at all. It's a zero-sum game. Somebody wins, somebody loses. If it is a bubble, a lot of people make money on the upside, mostly the insiders. But the pigs who want to hold because Nvidia is going to go to 1,000, sure. Then what happens? The stock goes down, and there will be a lot of money to be made in the downside. And of course, look at this. We have now Nvidia insiders cashing out, selling $51 million worth of shares. And look at this. They're dumping right now. Director after director after director, all dumping. Chief financial officer dumped. You think these people really believe in AI? Or do they believe in cash? Millions and millions of dollars. Folks, you don't need to do FOMO. Be disciplined. If you believe in the AI, you're going to get a better opportunity to buy these names. If you believe in a bull market, you're going to get a better opportunity in buying the laggards. If you believe that this is a bubble and down we go, you're going to get your opportunity in shorting these names. And lastly, let's comment on this because it's really fun. Of course, we have an upcoming cage match between Musk and Zuckerberg. And I'd pay to watch this. that goes without saying. I think they should sweeten the deal, and the winner in this cage match has to spend 50% of their cash in buying their own stock. Oh boy, all of a sudden now, you'd rather lose. You think Zucchini is going to buy his stock right now? You think Elon Musk is going to buy his stock right now? Think again, buddy. If anything, they're going to sell. But when it comes to this fight, I don't think it's fair, at least from a size or a proportional perspective, because you got Elon Musk, he's 6'2". People don't realize he's actually a very large guy. 6'2", I would say 250 pounds. Zucchini is about 5'6". I would say maximum 165 pounds. I don't know. From a weight proportional perspective, I think Elon wins. But then you got Zucchini. He has the reptilian moves. He's really fast, so I don't know. He's also younger, by the way. So if I had to bet, I would go with Zucchini. I think Elon has breathing issues. I think Zucchini would wrap around him like a spider and make him tap out. You know the interesting thing about size, because I used to do boxing, and again, I'm not a small guy, but I'm not really the biggest guy either, but I had to fight guys who are like 6'7", and I got to beat them because people don't understand that when you punch higher, you use a lot of muscles. And the power of the punch actually comes from your hips. See, Mike Tyson was a destroyer because, he was shorter, 5'10", 5'9", but he beat the living shit out of people because he had the strongest punch, utilizing his leg muscles. And I actually got brutally beaten by a smaller guy, not a bigger guy. So I would not underestimate Zucchini here. I think he could win. Anyhow, folks, we have a lot to talk about in the options market coverage, and we're gonna cover the morning brief in the charts analysis. But for now, let's move on to the coverage of the stock market, and we begin with the closing of the indices today. And here we go. The Dow Industrial Average down by 4.81 points, or a decline of 0.01%. The Nasdaq in the green by 128.41 points, or a gain of 0.95%. The S&P also positive by 16.20 points, or a gain of 0.37%. We look at the sectors all in all. No rotation today. If anything, it's back to the AI mania. We have communication services at number 1, capturing the gold medal. Number 2 for the silver, cyclicals, aka Amazon. And number 3, technology for the bronze. Energy leading the laggards, along with real estate, financials, utilities, industrials, metals, all down. But it's kind of weird that we have the AI mania, but we also have defensives and healthcare trading positive. So we have a mixed theme here, risk on in technology and AI. And then we have risk off in defensives and healthcare. Why are we seeing this phenomenon, Maverick? The answer is we have different participants right now. You got to understand that the aggregate demand for AI is really, really high when it comes to the retail mom and pops. So any dips on Tesla, any dips on Amazon, on Google, on Meta, they're going to buy those. NVIDIA, they'll try to buy those. But then we have a lot of institutional money that got out of the queues and got out of AI. It's kind of buying some of the defensives and healthcare right now. Today, I heard a lot of good things about healthcare. A lot of folks saying we're buying healthcare, but at the same time yesterday, I heard good things about energy. A lot of managers saying, hey, we're buying some energy here. Not today, though. Today, they're buying healthcare. So we have different participants right now. And everybody has a thesis. Everybody has a theory. If you believe in a recession or economic growth contracting, you want to be in defensives and healthcare, utilities. If you believe in China reopening and the stimulus, you got to be in industrials, in energy, in metals. If you believe in a rotation, then you got to be in financials and the small caps. If you believe in AI, you got to keep buying AI. We look at the breadth all in all. Look at this. You look at the indices and you get the false premise that we have a healthy market. The Nasdaq was up, the S&P was up, but look at these numbers right here. NYSE 27% advancing versus 71% declining. The Nasdaq 36% advancing versus 61% declining. Now we got one bad day this week, but believe it or not, that one bad day was actually pretty good. That was the only bullish day that we got this week, because the breadth was actually pretty good. Looks can be deceiving, folks. We move on to futures, commodities. What do we see here? Right off the gate, when we got the hike from the BOE, we saw oil prices getting crushed right away. WTI down over 4% for the day. Brent down almost 4%. RBOB is also down about 2.5%. Heating oil down about 4%. The exception, of course, natural gas. Natural gas already bottomed, and therefore I say a more positive nat gas than crude oil right now. Then we look at softs right across the board, the exception being lumber. We look at metals. The dollar was up a little bit, but we see a lot of pain in metals. Silver down big again, gold down, platinum down, palladium down, even copper is down. When it comes to meats, we have some rebounds here, although lean hogs is down about 3%. When it comes to grains, the strongest commodities as of late, and the reason is the drought. Look at this. Drought all over the place. specifically in the most important regions. It's no wonder why we've seen a huge pop in wheat, specifically oats. Soybeans kind of stabilized as of late, but there is no doubt that we have seen a big pop in grains as of late, and if the dollar continues to go down, we could see a sustainable rally here. Moving on to options, the big casino, what do we see here? The volume all in all is about average, but we still see a lot of buying of calls, although it's kind of coming down a bit. Not enough to say that we have a change in trend, but these are the kind of things we have to watch for to spot a change in trend. Of course, when we start to see puts outweighing calls, it will be already too late. So the question is, you have to spot the changes in trend before they happen. Right now, we're getting really close. We used to see 60s calls, 40s and 30s puts. Now we're seeing 50s in calls, 40s and 30s in puts. If we start to dip down to the lower 50s, that would be a leading indicator that folks are switching to puts, and we're soon about to see a change in trend in equities. But until then, we have Tesla number one with about 2.6 million contracts traded today. About 61% of those were calls. Look at this, Amazon number two with around 1.5 million contracts traded today. About 71% of those were calls. So if you're wondering why did Amazon pop higher today, it's a gamma squeeze. It's all about options. The company came out today and said AI, and as a result, of course, a lot of folks bought call options, and we see the stock of Amazon moving higher. Nvidia at number three with around 950,000 contracts traded today. About 54% of those were calls. And then I'm watching AMC. AMC was down big today. And as you can see, 60% puts versus 41% calls. So something weird is going on here. Anyhow, speaking of weird, let's talk about the VIX because this is the subject du jour that has been going on for days now. What's going on with the VIX? It doesn't matter what happens to the market, up or down. The VIX keeps going down. What's going on here? If we look at the monthly expiration for the VIX, look at this. For the calls, we see huge volume coming in for the 15 calls. Huge volume coming up for the 18 calls. And I'm talking about the open interest. Look at the OI change. Lots of contracts being bought for the 15 and 18 calls. This is for July's expiration. You look at the puts though, they're still buying those. Huge volume is coming in. It's coming in for the 12 put strike. In other words, it seems to me they want to get the VIX all the way down to 12. And we have the rubber band scenario. They pull it all the way down to 12. And then we see the VIX shooting up higher to 15, 18 rapidly. Now, is it going to go down to 12 exactly? The answer is, I don't know about that. It could go down to 12.5, 12.3, and then it starts to reverse. The question becomes, what are the implications for the equities market if we see the VIX going down to 12? Well, the assumption should be that the SPY will go higher. But we have seen the VIX rallying along with the SPY, and we have seen the VIX getting crushed along with the SPY before. The VIX is acting really, really weird. But assuming the VIX is going to go down to 12, then the assumption is the SPY should rally for a little bit. A little more. Then the question becomes, if the SPY rallies, is it going to rally based on the AI big cap names or because of the rotation? The answer to all of this is I don't know, but these are the kind of things we have to watch out for. If the SPY is going higher, is it going higher because the kind of action that we got yesterday, the rotation, or the kind of action that we got today, the AI mania? Is the market maker satisfied enough that the VIX is now trading at the 12 handle, and that's good enough, and now they have to pop it higher? Who knows? What we know is it's really suppressed, and we know what they're aiming for. They're aiming for 12. And then we see a lot of inflows for the 15 and 18s. My reading of all of that is the rubber band scenario. Pull it all the way down to extremes and then let it go. Now we have to look at other options, and I want to illustrate something for you here. Look at the monthly expirations for Tesla. The stock was up by about 2.5% today. But look at these options. They're not printing anything at all. 9% here, 10% there, 7% here. That's not really a good return for options. Why are we seeing this phenomenon? The answer is calls are really, really expensive in Tesla. And at some point, you're going to get exhausted. Of course, the traders aim for shorter expirations. They're aiming for this Friday's expiration, 0 day till expiration options. But you have to look at this as a leading indicator because the market maker is already covered for the weekly expirations. The market maker has to look for this, the monthly expiration. This is the most important feedback. What they see here is that they priced these premiums really, really high to the point where traders are not going to make money and traders will have to bail out. They have to say, okay, Tesla's up 2-3% in a day. My options are up 9%, 8%, 7%. That's not good enough. And then I see another stock, Amazon. Well, the options over there are up 300%, and they have to rotate. But we see put options buyers showing up in Tesla, and that's how the trend changes. Now, of course, we're seeing the first signs of a change in trend in Tesla. The same so-called analysts who've been pumping Tesla and kissing its ass in the last few weeks, chasing the rally, Johnny-come-latelys, and now saying, we're downgrading Tesla, but we're keeping the price higher. We're downgrading the name, but we're boosting the target to 250 from 200. What a bunch of clowns. Is this helpful to anybody? Is this of value to anybody when these analysts do all of this? You're downgrading the stock, and we know why. You're Johnny-come-lately. You're looking at the RSIs. You're looking at the change in trend in options. You're looking at the support lines, and you're saying, okay, the risk versus reward says the stock will go down. So I'm going to be wise ass over here and come out and say, I'm downgrading the stock, but to have an insurance policy in case the stock keeps going higher. I'm going to boost the price target to 250 from 200. Again, what a clown this guy is, Adam Jones. Dude, the stock is already at 250. Your price target was 200. Now you're telling us that it's going to be at 250 after the fact? Do you guys see how filthy and disgusting this industry is? Anyhow, let's look at NVIDIA weekly expirations. Look at this. They're still buying out of the money, but they're losing a lot of money because the premiums are way too high. This is for the expiration date of tomorrow. Yet look at these premiums. It's impossible to make money. The market maker is smart. They price these things way too expensive. And you and I, like a bunch of morons, we chase this stuff, but we're paying too much. All of this money, look at all of this volume, all of this open interest out of the money. All of this is being collected by the dealer. Look at puts. They're all down to, so it doesn't matter. You buy calls, you buy puts, you're going to lose. The dealer wins. Why? Because they price these options way too high. Even if the stock moves in your desired direction, you're going to lose money. And the only way for you to make money in these stocks if they pop by 5-6% in a single day. For example, look at the monthly expiration for Amazon, calls. Look at this. The stock is up, 5% today? And even with that, the best you can do is 80%, 100%, 120%. That's not bad. But then you look at Merck, for example. MRK, monthly expiration. The stock is up about 2%. And look at the appreciation here. 60%, 70%, 80%, 100%. Not as good as Amazon. But the options here are cheaper. So you don't need the stock to go 5% in a single day. You just need it to go higher by 1-2%. You can make a lot of money from these options. This is a lesson in implied volatility. The implied volatility in the big cap names and the AI mania is way too high. Either of these stocks are going to pop by 5-6% in a single day. Otherwise, you're not going to make money. And the same goes for the puts, by the way. Unless they go down 5-6% in a single day, you're not going to make a lot of money. The opportunity is always in the boring names. When they pop higher all of a sudden, out of the blue, that's when you're going to make the most money. Anyhow, moving on to the unusual activities that took place in the options market today. We begin with the ticker EURN. This is for a company called Euronav. It's a Belgian company, oil and gas company. We have seen huge volume in this name, but somehow it did not move. Maybe it's time for it to move now. So somebody bought the 18 calls for the expiration date, August 18th, with expectations that the name will go higher and gain more than 11% by then. They paid about 70 cents a piece to enter this trade, all in all spending about $700,000. Then we have TSM Taiwan Semi. Somebody sees the name moving higher and they bought the 117 calls with expiration date July 21st, with expectations that the name will move higher and gain more than 13.5% by then. They paid about 45 cents a piece to enter this trade, all in all spending about $500,000. And while energy was down today, somebody sees the rebound coming and they bought the 83 calls for the XLE with the expiration date August 18th, with the expectations that the name will go higher and gain more than 6.5% by then. They paid about $1.20 a piece to enter this trade, all in all spending about $600,000. Continuing with interesting trades, what about the ticker TTWO Take-Two Entertainment? Somebody sees the name going down big, and they bought the 120 puts for the expiration date August 18th, with expectations that the name will go higher and lose more than 15% of its value by then. They paid about $1.20 a piece to enter this trade, all in all spending about $500,000. Last but not least, What about the ticker SIMO? This is for a company called Silicon Motion Technology. It's based in Hong Kong. It's a semiconductor name. Flying high even today, but somebody sees perhaps the top is in. And they bought the $60 puts for the expiration date, August 18th, with expectations the name will go down and lose more than 16.5% of its value by then. They paid about $5.50 a piece, tenor. This trade, all in all, spending about $2 million. We move on to the heat map analysis. What do we see here? Not a good look, folks. You see banks down big, we see industrials down big, utilities, real estate, energy, metals, all down. Even the cyclicals are down. What's working today? The big caps. So we see net inflows into these big caps. Some of them, of course, experienced a gamma squeeze, such as Amazon. That's why it's the outperformer for the day. And of course, weirdly, we have healthcare and defensives working out today. So yours truly is kind of happy. Not really, but kind of happy that the defensives and my healthcare names are at least moving a little bit higher. And I know that not everybody here is an options trader, for example. A lot of you are investors and you have long and short portfolios, or mostly long portfolios. And I would say do yourself a favor. Look at the charts in some of these healthcare names. Look at J&J, for example. That chart was never in a bear market. That chart is still bullish. And every time it goes down to the trend line, it bounces higher. Look at Merck. Never been in a bear market before in 22. It's a bullish chart. Look at PepsiCo in defensives. That's a bullish chart. Never been in a bear market in 22. So as an investor, you have to follow these trend lines until they're broken. And if you have these stocks going down to the trend line and they hold and they bounce, you gotta ride them higher. If you don't want to chase the mania, it's too volatile for your taste, you got a lot of good names here. Never been in a bearish market. Never been in 22. Then, of course, you have other names like AbbVie. If you look at that trend line, we got a retest and it's broken now. But J&J, you see a retest and a rebound. I said I'm liking Bristol Myers too. It needs to go a little bit down all the way to the trend line and then maybe we'll start looking at it. So you have a lot of opportunities here besides the AI mania. The question becomes, how long will it last? And I say until the trend lines are broken. If PepsiCo, for example, breaks the trend line, then I'm out. But for now, it keeps the trend line intact. It keeps bouncing and moving higher. So I'm going to stick with that until the trend is broken. We move on to the ETFs. Look at this right across the board. And if you look at the big caps, big cap growth, that's working today, but value's not working, mid cap not working, small cap's not working. So it's not really a good rotation today. We go back to the AI mania. And the problem with the AI mania is it's stopping fundamentally. It's stopping technically now. It's stopping mechanically. It's becoming really dangerous right now. The fact that we're not seeing a rotation. What happens if the AI mania comes down crashing? What's going to hold this market? Energy? Well, that's not working anymore. Healthcare? It's been flattish. It's not big enough. Banks are down big today. The cyclicals, retail, XLY, without Amazon and Tesla, no way. Real estate? The question I want to pose to you is, what's going to hold the market if the AI mania goes down? And I'm not saying a crash either. Let's say the AI mania goes down by 10%. What will hold the S&P 500? If these sectors are not really holding, let me know in the comments. Now let's do some charts and then wrap it up. Here's the morning brief for today, and I gave you some numbers. You can pause this and read it for yourself, but I gave you some numbers in the morning. The gap fills the supports, and I said, look, what I'm looking for is an initial buy the dip rally, but they stop at the gaps above that is. In the case of the Qs, for example, it's 362. The case of the SPY, it's 434.94. In the case of Tesla, it's 263.12. In the case of Apple, it's 183.96. And then we see a failure in these names, and then they go down to crack supports below. In the case of the Qs, 360.42. In the case of the SPY, it's 433.79. In the case of Tesla, it's 249.16. In the case of Apple, it's going back to 182. But that did not happen. All of these charts managed to trade to these gaps above and the numbers that I gave you. And they stayed above and they traded higher. That was the early sign that this is going to be a bullish day, not a bearish one. We're going to see more buying, not selling. So you have to look at these numbers not just from one perspective, that, oh, it's going to be resistance and then we go down. And if we go down, that's it. What happens if these charts break above these numbers? Then they become support. What are the implications of breaking these numbers and trading above? It means the opposite is going to happen. So you always have to look at these numbers, not from one perspective alone, but what happens if the opposite takes place? What happens if a support line doesn't hold and it becomes resistance now? And if we're expecting dip buying at the support, now we're expecting sell-off to the next support. And here, for more clarity, look at this, the SPY, the S&P 500, 30 minutes chart. chart, what do we see here? We got the gap down in the morning, caught support from 433.79. Then we closed the gap. You see that white line? That's the gap. Closed the gap, traded above. Went down for a little bit, but kept that gap support intact. Over and over and over and over again. That was the signal that we're not going to go down to breach the support of 433.79 as I would have liked. Now, does this make the tape bullish? The answer is it is bullish because we closed at the highs of the day and we closed positive. Now, the question becomes what happens tomorrow? If you look at the RSI, if you look at the MACD, they're all firming up, at least on the 30-minute chart. So the assumption is the SPY wants to give it a shot at closing the gap above. Most importantly, retesting 438 as resistance. This is what the chart says right now. Of course, we can wake up in the morning and we have bad news and we have a gap down in the SPY. But for now, the chart is saying if the volume stays low, it wants to go to 438. Now, if that's a failure, and then we go down to 433.79 and we break that as support, then we got to trade all the way down to 430. But so long as this support is intact, we don't have the trade. Look at the daily chart for the E-mini futures. Again, within a range, support 43.84.5, the resistance at 44.23.75. And I'm cautioning the bears not to get too excited about the pullback. And the reason is, if we zoom out a little bit, this could be a beginning of an ABC pattern. It's not my base case. If you look at the momentum indicators, the RSI and the MACD, those are saying down we go. And we're going to go down all the way to close the gap at 4,300. I mean, that gap is going to be closed 1 trillion% because this is a continuous chart. We're not going to keep this gap forever. The question is it going to happen in this leg or is it going to happen later? Of course, we have 1 day left in trading, so a closing above 43.84.5 would be a win for the bulls. A closing below would be a win for the bears. Not quite the reversal yet, but it would be considered a win for the bears because the battle of 43.84.5 is concluded. And the bears won. This is what I'm watching for in tomorrow's activities. We look at the Q's 30-minute chart. What do we see here? We got the gap down, and as you can see, this line, this white line, this is the gap fill. So we got support 360.42. Then the Q's trades above the gap, holds the gap. That was the leading indicator that today is going to be bullish, not bearish. And on top of that, the Q's goes above 364.11 and recaptures that as support. So was the tape bullish today? The answer is absolutely. And if it wants to continue, we have another gap fill above. And of course, if it wants to go really, really crazy, it can go all the way back to 370. But this is not the base case, and this is why. Look at the daily chart for the continuous contract for the Qs. Again, you could look at the chart and say this could be an ABC pattern, and higher we go. The problem is, look at the indicators, RSI and MACD. They're both topping, they're both moving down, but we need to see one support line lost, and that is 15,000. So in tomorrow's activities, I'll be watching for 15,000. If the bulls keep that as support, it's a win for the bulls, and more likely than not, we're going to see an ABC pattern. If they lose 15,000 tomorrow, it's going to be a win for the bear. More likely than not, we're going to see a closing of the gap at around 14,445. We look at the IWM 30-minute chart. What do we see here? We're now back at the lower end of the channel, and the chart did retest 183 over and over and over again. It closed above, but is it decisive? The answer is not really. You can look at it in a bullish way and say, look, the chart did retest 183 over and over and over and over again, and it had plenty of opportunities to crack below the number. It did not. That's bullish. It means higher we go in the IWM tomorrow. Maybe tomorrow it's going to be a rotation day. If you look at it from the bear lens, okay, we got to retest the 183 over and over and over and over again. But why couldn't the IWM rally by the end of the day? Why couldn't it go all the way higher and close the gap above? This means it doesn't have the energy. Sooner than later, we're going to crack below 183. For now, does it lean one way or the other? The answer is absolutely not. 183 is the most important number. If it is kept, higher we go. If it is lost, down we go. 182 would be the next support. And then we'll look at the Dixie, the dollar index, 4 hours chart. What do we see here? It is bouncing off support at 102. Is it a strong of a bounce that higher we go? The answer is not really. I think we go down in a retest of 102 once again because you have all of these central banks raising rates and the Fed pausing. This will add a lot of pressure on the dollar. But if the dollar is about to go down, then how come gold is not performing at all? Gold broke support at 1928. In my book, this is a signal to short. But is it confusing? The answer is absolutely yes. Because if I'm saying, hey, you got to short gold right now because it did break 1928, then doesn't that mean that the dollar is about to pop higher? Sure. That's the assumption. But when you look at the chart of the dollar, it doesn't really look that good. Somebody's lying here. Somebody's pulling a trick, which means am I going to short gold here? The answer is not really. I have to see the Dixie above 103 again. Otherwise, I don't have a confirmation. This could be a trick. I could short gold right now, only for it to pop in my face because the dollar goes down big. You look at silver, SLV, weekly chart, look at this. Gap down, bad candle, losing momentum. And the assumption should be we have to go down in a retest to the lower end of the channel. Folks, usually precious metal markets are really stable. Not these days though. We got to take it easy here. We need to have a definitive confirmation by the dollar. I know a lot of you want to buy gold and silver, but how could you do so without a confirmation by the dollar? I don't feel safe. You look at Brent oil daily chart, look at this. 77 is a really tough number. And now we have what it appears to be a reversal candle. Of course, the week has one more day left, but this is not a good look. Oil has to crack above 77 in Brent sooner than later. But honestly, folks, let's talk about China, because this chart depends on China. Do you believe that China is going to recover or not? Do you believe that the Chinese stimulus will work or not? If the answer to these questions is no, then you should not be long oil. If the answer is yes or maybe or I could see it, then you can hold on to it for a little more. We look at the daily chart for the 2-year yield. What do we see here? It continues to grind higher. And folks, we're getting into the danger territory here. We're talking about 4.8. Soon enough, we're going to go back to 5. I have a hunch. I have a gut feeling right now. And I know we're not going to trade based on hunches and gut feelings, but I have a hunch that something is about to blow up. We don't know what it is, but as these yields continue to go higher, not just here, in Britain, in Canada, in Australia, all over the world right now, something is about to blow up. And that could explain why I see the 2-year flushing down and the VIX popping higher significantly. And with that comes a massive pullback in the stock market. Now, if that thing that's about to blow up is another regional bank, then it's no biggie. The Fed will come out with the hose and put it down and flood it with liquidity again, and probably the stock market will go higher. But if it is a systemic risk, if it is a big one that the Fed cannot put down, then boy, we're in trouble now. This feels eerily similar to August, September 2008. We got out of Bear Stearns. Everybody assumed that, okay, we see the weakness, we see the warning signs. We got the layoffs here and there. We know there's a problem with the real estate sector, but everything else is fine. You go back to 2008, the summer of 2008, that is, I was in the city of LA, and I remember that, gasoline prices were horrible. I had one of those gas guzzler cars. Cost me $100 to fill it up, but you look around. Restaurants are full. The tourists all over the place because the dollar was down back then. There were a lot of Europeans around. You go to any of the tourist destinations, full, packed. How could we have a recession when everybody's consuming? And now we see the same thing. We have inflation. We know about it. We know what the systemic risk is. We know about regional banks. We know about commercial real estate. We know about the layoffs in the tech industry. And now it's becoming contagious. But everybody says, oh, the consumer is doing pretty good. And then next thing you know, it's going to hit us suddenly. If you recall in 2008, we knew about Lehman. We knew about the problems in Lehman since 2007. But everybody said, oh, Lehman is so big. Lehman is not going to go down. Come on. Until it did. And then after Lehman collapsed, came the panic. And we started to hear about AIG and Freddie Mac and all of these companies also needing bailouts. And of course, Washington Mutual. But at that time, after Lehman, when the panic hit, everybody started liquidating portfolios. Everybody rushed to the exit door at the same time. And I have a feeling that what we're doing right now is eerily similar to that. We're pumping AI. Everybody says, nothing to worry about here, nothing to see. But you look at this chart right here. What got us into the Silicon Valley disaster and First Republic Bank, we're revisiting the same territory, only later on, only when these companies are a lot weaker, only when the risk is accumulating. Keep that in mind, folks. We look at the TLT, again a failure at 103.5. There's nothing you can do here. You can only watch. You want to own the TLT, sure, but have a tight stop, and that stop would be 100. Goes below 100, you got to abandon. Here it is, the VIX. Look at this daily chart, losing momentum now in the MACD and the RSI. And the question becomes, are we going to see the 12 handle? I showed you the options, and the options say yes. We have to go down to the 12 handle. Not exactly, but a little closer to 12. And then we see the rubber band blasting higher. Why do I say that? Because you have a lot of 15 calls being bought, 18 calls being bought, a lot of 20 calls being bought for the monthly expiration. But the puts stop at 12. We don't have a lot of folks buying the 10 puts in the VIX. Matter of fact, a lot of them are not even issued yet. For example, if you want to buy the $8 puts in the VIX, there is no volume there. The bottom line is, what I'm saying is 12 is where it taps out. And then what happens? We only have upside coming. And I know what you're going to say, hey Maverick, but you've been saying this since last week. I know that. Trust me, if I have the timing right, I would not be doing this show at all. I'd be hiding in a bunker, being busy becoming the richest man in the world. I cannot give you the timing, but I can give you the conditions. And the conditions right now say the VIX is suppressed, but we have a limit. We know what the limit is. And we see the buying 15, 18, 20 calls. And the way I'm doing it, and I got stopped by the way today, is I'm buying the UVXY, $2, and I'm keeping really tight stop loss. So if I'm buying at $2, my stop loss is $1.99. I got stopped in the first one. If I get stopped in the second one, maybe that's going to happen. But the bottom line is, because we don't know what the timing is, this is the best strategy. If you buy VIX calls, you're going to face decay. But if you buy the UVXY, for example, $2 a piece, and sure, we have the split coming. Everything is going to be adjusted, folks. If you buy 1,000 shares of the UVXY $2 a piece, and then the split gets it all the way to $20 a piece, you're going to have 100 shares. Simple as that. But the beauty of this strategy is, I don't know what the timing is, but I know we're getting close. So you buy the UVXY, $2 a piece. You have a tight stop loss, $1.99, $1.98. You might get stopped right away. Try it again, over and over and over and over and over again, with really tight stop loss. And then when we get the pop, not if, but when we get the pop, you sell upside out of the money calls, covered calls. And at that time, they're going to be really expensive. So you're going to pocket a lot of money. It's going to make up for your entry cost. And then as the VIX start to turn down, we dump the position altogether. It's over. Here's Apple, an hourly chart. Look at this. We talked about, you see that line, that white line? So we opened gapping down. And the goal was that Apple goes all the way to the gap, or 185, then it stops and it moves down. But this is not what happened. We see Apple right off the gate, lots of volume coming in. It cracks above the gap. It cracks above 185, and it closes at the highs of the day. So forget about that lotto ticket. Not going to happen this week. It worked out yesterday, though, for a little while. Gave you 400% returns yesterday, not today, though. So what does that mean? Are we about to see higher highs in Apple? The answer right now, based on this closing, yes. But then we'll look at the daily chart, the weekly chart. They're all getting overbought. This is really dangerous, but they continue to flow in, which again gets me to the point of we might see a rug pull here. We've been saying this for weeks now, but this is the kind of action when you see the VIX suppressed, when you see the market numb to all of this risk, when you see flows coming in, regardless of the RSIs, regardless of the overconcentration. You're begging for a mechanical risk event, the rug pull, quote unquote. And by the way, I think most of you would embrace the rug pull, because if it happens, it's going to normalize a lot of things. It's going to fix a lot of divergences. It's going to normalize the VIX. It's going to normalize the RSIs. Everything is going to go back to the mean. So what I'm hearing from you all day long in Discord and otherwise, you actually want to see the rug pull. Interesting. Then we'll look at Tesla, an hourly chart. Look at this. We talked about the trend line. We talked about 249.16. We got a bounce out of that support line right off the gate. And it traded above the trend line, and it never went down to trade below the trend line. So right off the gate, we know that this is going to be a bullish day, because Tesla, the most important name, along with NVIDIA, but NVIDIA is another case right now. Tesla bounced off support, regained the trend line, never retested the trend line, never failed the trend line. So by 9:30 Pacific time, you should have known right off the gate that this is going to be a bullish day. The problem for Tesla, of course, is it is short of 265.25, and we know that the gamma squeeze pretty much ended. We have the Johnny-come-latelys right here defending 249.16, but for all intents and purposes, the gamma squeeze is coming to an end. And the reason is it's becoming really, really expensive to buy these premiums. You need the stock to be up 5% plus every single day for these call options to print. Otherwise, you're not going to make anything. You might even lose as the stock continues to go higher. All what we're looking for right now is if we see a huge number of puts showing up, not out of the money, but closer to the money with the monthly expiration, and we see Tesla losing 249.16. And we got the confirmation this is over. And here's Meta. A lot of you want to talk about Meta weekly chart. Look at this. We know that the upside target is about 300.68. Let's call it 300 even. And then we know that the mean where Meta should go down to is about 224.20. That's the mean. In other words, Meta is going to be down at 224.20 sooner than later. But could it happen after earnings, for example, and after Meta reaches 300? The answer is that is a possibility. So today in Discord, we have a viewer who said, is there a shorting opportunity in Meta? And how can I do it safely with a hedge? Here's the answer. Now that you know these ranges and these levels right here, you can buy the 260 puts for the expiration date of August And now that we know 224.20 is the mean, so we go a little above, but we sell the 230 puts. It's going to cost you $8 a piece for buying the 260 puts, and you're going to receive about $2.50 a piece from selling the 230 puts. And then, since you want to hedge, you say, okay, I'm not sure, maybe Meta is going to go all the way to 300. So you want a shorter term hedge. You can go to the July 14th expiration, then you buy the 300 calls. It'll cost you about $3.50, and then you can sell the 310 calls and receive about $1.75 in credit. All in all, the entry cost for this trade would be $7 a piece. Expensive, yes, but this is the price of hedging. You can go naked and buy the 260 puts right off the gate, but what if Meta goes all the way to 300 before it goes down? On the other hand, what if Meta goes down all the way to 260 and below before getting to 300? Then the hedge is worthless. These are the kind of things that you have to weigh in as a trader. The risk versus reward. If you want hedges, it's going to cost you. It's going to limit your profitability, because if you're paying $7 to enter this trade, you really need to see Meta going down to 230 by the expiration date in August. Otherwise, you're not going to make money. And then we have AMD 30 minutes chart. What do we see here? We talked about the wedge pattern, but it did not break out. So now we have to wait out for 108.27. That's the gap. If it fills the gap and it starts to go higher, then it's a buy. At least for a trade, you get it all the way to 112, 115. In, out, hello, goodbye. But I have a hunch, because this is how these things work often. You wait for the fill of the gap, but the stock pops before filling the gap. So could we wake up tomorrow and see AMD up 5%? That's possible. So a lot of you saying, hey Maverick, why don't you just spit the lotto ticket trade for tomorrow? Give us the call options for AMD. The answer is, if I do that and then AMD goes down to the gap and it closes negative tomorrow, what am I going to say to you? Because this was obvious. So the discipline says you got to wait for the gap fill. But the hunch and the experience says that often than not, we see these things popping and rebounding before it gets to the obvious target. I'll leave this one to you. Now, a lot of you ask about AAP, which is Advanced Auto Parts. Look at the monthly chart. I mean, a lot of you are looking at it because it's cheap. It's now trading below the book value. And I say, look at the monthly chart. It has broken trend. Aggressively so. And now it appears that we have a negative trend, which means it can go down further. The only reason to buy this stock right now is a lotto ticket. That, okay, you're going to buy it right now. And then we hear the news that AutoZone or O'Reilly bought Advanced Auto Parts, and we see the stock up 30%. That's the only reason to buy this stock. But for all intents and purposes, this company is going bankrupt. I mean, based on the latest report, I don't see how they're going to survive. And lastly, we talk about tulips. Look at this headline. Bitcoin price spikes to 138,000 on Binance US. So we got a fat finger trade that got Bitcoin all the way to 138,000. But of course, it did not register except on Binance. Yet you look at Bitcoin right here. Massive pop, but is it running out of steam? The answer is yes. Look at the volume. It's receding. It means that without higher volume coming out tomorrow, we should go down to the trading range. We should go down to the consolidation range. Now, since everybody's talking about Ethereum, ETH, we look at the daily chart, it's looking a lot worse than Bitcoin. The action is all about Bitcoin. That's the one that BlackRock is after. It's not really Ethereum. It's just catching an empathy bid. But you look at this candle that we got today. It's not a good looking candle. And we might get a follow-up, a confirmation, another red day, which will confirm that this was a transitory pop in ETH. So right now, at this stage, I would stick to Bitcoin, not Ethereum. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? Look at this. We have San Luis Fed President Bullard. What is he going to say now? And then, of course, we have the PMIs, services, and manufacturing PMIs. These are really important. And on top of that, we have Cleveland Fed President Mr. We'll see what she has to say. But, folks, a reminder, if you happen to be in the Top Gun tier, we're going to have a live stream coming out tomorrow. We'll try YouTube. Let's see how that will work out. Besides that, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.